Okay, thanks for joining us for today's webinar. Today's agenda will be US Big Tech second quarter 2022 equity strategy. So for Big Tech, it stands for, what we mean by Big Tech is the FANGs or the FANG-M. So these 6 companies, Facebook, Apple, Amazon, Netflix, Google, and Microsoft, these 6, the biggest tech names in the world, and that's what we mean by Big Tech. The title of our webinar today is Selective Posture. We're more selective among the FANGs at the moment. So within the 6 companies, we're being more selective in this environment of slowing growth and valuation compression after a pandemic spike. Next slide, please. Just a disclaimer, this webinar is for educational purposes only. The information is from public sources and does not take into account your individual specific investment objectives. So do look for your investment advisor if possible. Okay, so we'll just start off with a review of the first quarter of this year. So the picture here is Noah's Ark. So Noah's Ark. Okay, so if you all heard about the ARK ETF, the ARKK ETF, it's actually ETF with all the tech companies that don't really make money. They're actually still making losses, most of them. So, but we think that the real up in the market in the first quarter of this year was actually the quality tech, which is the FANGs that's really supported the tech space. Next slide, please. Okay, so this is just the returns for the asset classes. So on the left-hand side, you can see the FANG-M, so it's Facebook, Apple, Amazon, the 6 companies. So if you can see on the yellow bar, it actually declined 9% in the first quarter of this year. And this is in line with the Nasdaq, which fell about 10%. So both of them underperformed the S&P. The main reasons is because of the rising interest rate environment and also economic growth uncertainty. Bonds also did poorly, so negative 8% for the quarter. Gold did relatively well. It's a hedge against uncertainty and the bond bear market at the moment. Commodities was the best performer in the quarter as well. But the worst performer is the ARK ETF. So it consists of the profitless tech companies that don't make money. So it acts like a leveraged Nasdaq ETF. So which is very unlike the FANGs, which generate very healthy profits. And so that's why you can see that the FANGs were actually the ones that prop up the tech space rather than those growth companies that don't really make much profits. Okay, let's move on to the macro themes. So the macro themes overall, just a slowdown in the economy and also a reversal of the pandemic-induced work from home effect. So the big question on everyone's mind is the yield curve inversion. So it recently happened, the yield curve inversion, and it was in the news recently, and it's a good indicator of recessions, which is also why economies are, which is why people are sort of expecting slower growth moving forward. So this, if you look at the chart, the red line is actually the yield curve, which is the US Treasury yields, the 10-year yield minus the 2-year Treasury yields. Okay, so and the blue line is the Nasdaq price. Okay, so if you look at the chart, when the yield curve flattens, which is when it flattens, it means that the red line is moving downwards. So when it flattens, it doesn't really equate to a correction in the market. So the market can still perform. The blue line, you can see it's still going up when the red line is going down. But when the yield curve inverts, is when it drops below the zero, when it goes negative. And that's what happened recently. Only when it inverts. And then once there is a recession, then the Nasdaq will see a sharp correction. So you can see that in 1989, 1990, there was a recession after the inversion. And then you had the sharp correction in Nasdaq. Then you had the inversion in the dot-com era, the year 2000. And then you had the dot-com recession. And then you had the GFC. So the risk now is that the inversion that we just had can lead to a period of weakness based on historical terms. The next question, the next point, okay, the next question is the Nasdaq, if that's the case, is the Nasdaq entering a long-term bear market? Okay, that's the other risk. Okay, so the chart you see here is actually the Nasdaq forward PE ratio chart. Okay, it's for valuation purposes. The higher valuation means it's more expensive. The purpose of this chart is to see whether valuations are at extreme levels. Because if they are at extreme levels, then we may enter a long-term bear market if growth starts to slow down, and then valuation starts to compress back to the normal long-term average. So right now you can see the forward PE on the right-hand side right now is around 25.9. So it's not as expensive as compared to back then during the dot-com boom. The dot-com period when it was up to 100 times PE. But the worry now is that because the valuation spiked up during the pandemic, because everything went digital, everything went online, so it spiked up during that time. But now growth is scaling back due to the reopening of the economy, the removal of the work from home effect. So we might see the valuation premium correct down to maybe to the historical average due to the growth slowdown. So the historical average is around 23.9, which is so you might see another correction of about 10% roughly to revert back to that mean. And it also might overshoot a bit if there's additional growth scares. But the other point, it's not really as expensive as back then in the dot-com boom. But what happened after the dot-com was that there was also a stagnation of growth. And when there was a stagnation of growth, you can see at the red arrow there, the valuations remain flat for a long period, maybe 7 years, or maybe 6 years. So we didn't see any valuation expansion for many years in the Nasdaq during that time of low growth. So we think that there is a risk now because of slowing growth that we won't get any valuation expansion for relatively in the medium term due to the slowing growth after the spike during the pandemic. So in order for share prices, we think to break new highs for the Nasdaq, we think that earnings growth is key. It's key now to drive share prices up beyond the peak, and so earnings growth. That's why we are much more selective now with regards to the stocks we pick in the FANGs. Okay, next slide, please. Okay, we move on to the sector trends. Okay, the first sector for these big 6 companies is, the first one is public cloud. So just for the benefit of everyone who doesn't know what is public cloud, for your Google Drive, your OneDrive, Microsoft OneDrive, Microsoft 365, all these storage solutions are all provided over the internet. You don't have to download anything. You don't have to buy any storage equipment to store any of your data. You store it over the internet. So you store this data in the cloud. And so when companies utilize the cloud, let's say a company utilize the cloud, they don't have to invest in a big data center to do so. So it saves them a lot of money when they use the public cloud instead of investing in their own infrastructure. And so this is what the cloud means. And this is really a big strategic decision that a lot of companies are using right now to remain competitive and to reduce costs and to benefit from a lot of other things like AI and data analytics. And Netflix is one of the companies that heavily utilizes the cloud. So they rent the computing power from Amazon, and then they don't have to invest in their own data centers, and they have a global reach. Okay, so Amazon is in this segment called the IaaS, so infrastructure as a service, where they provide the computing power of all their data centers to their customers. And this is the fastest growing segment in the cloud, growing at 29% compounded annual growth rate compared to the whole cloud market, which is at 21% only. So we are overweight on this sector. Growth is expected to continue as corporations continue to digitalize to remain competitive. It's a need for them. So this will benefit Microsoft and Amazon, and also Google, which are the 3 largest cloud companies in the world. Amazon Cloud Services is expected to grow about 40% in the next. Amazon is all the 3 cloud players are expected to grow their cloud computing business by more than 30% this year as a projection, and growth doesn't seem to look like just it's slowing down. Okay, the next sector we'll look at is the e-commerce sector, which is largely focused on Amazon. So in the chart, you can see that you can see the US consumer spending in this chart. Okay, so the blue line is the spending on services and also gasoline. We combine the two things. The red line you can see is what people spend on for their household goods, like their computer, their furniture, and all these kind of things, which spiked up during the pandemic when everyone's just remained at home. So the pandemic caused the consumption of services and gasoline to fall about 40% because everyone was stuck at home. So as we reopen, we worry that there may be pent-up demand for these services. And also people will start spending more on gasoline because the prices are so high now. So the spending on gasoline may take up more of the consumer budget, and this may cause people to spend less, not so much, don't spend so much on goods anymore. So when they start spending more on goods, then we may see like a slowdown in e-commerce sales because they mostly sell goods. So this may hit some of the tech names like Amazon. But still, e-commerce growth is expected to grow more than 10% year on year. So it's still a very solid growth. So we remain neutral on this sector. Okay, I pass on the time over to Jonathan.
Thanks, Tim. So I'll be talking about digital advertising. Basically, digital ad spending continues to increase steadily. They've grown at a 3-year CAGR of 14%, and this is predominantly due to shifts in consumer behavior and preferences as more and more people spend more and more time online. So marketers are also kind of putting more money into digital ads in an effort to capture the attention of these online users. So digital ad spending continues to contribute a large share of overall market advertising spend. So right now it's at about 60%, and it's been increasing about 1 to 2 percentages each year. And we do expect this trend to continue moving forward, just based on how effective digital ads have been in the past. So total digital ad spending is expected to hit about $680 billion by 2026, compared to only about 465 billion currently. 60% of all this spending is done on mobile and 40% on desktop. And this has kind of been the trend for the last couple of years now, especially as more and more people kind of use their smartphones more than they actually use their smartphones or tablets more than they actually use their PCs. However, we do see some sort of moderation in overall market growth. We expect it to grow at a CAGR of about 8% for the next 5 years. And this is generally largely because digital advertising has grown so much so quickly in the especially over the pandemic. So it should be quite natural to see some moderation here. Within digital advertising, video advertising actually continues to outgrow the overall market. So it grew at a 3-year CAGR of 19%. And we do expect this trend of growing faster than the overall market to continue, especially with the growing popularity of short-form video platforms like TikTok or your Instagram Reels, and even to a smaller extent, YouTube. So currently, there are really only 2 main outlets for digital advertising, still with Meta and Meta Platforms and Alphabet. But there is, to a smaller extent, advertising on Amazon and TikTok as well. Alphabet still actually dominates the digital ad industry with more than 50% market share. So now we'll move on to video on demand streaming with our title of Slowing Growth. Video on demand is actually just basically entertainment that you watch through the internet, anywhere, anytime. So I guess your best example for this would be Netflix, Disney, Hulu, Amazon Prime, which is incidentally are the main players in this space. So this chart essentially shows the total addressable market for streaming companies and the corresponding ARPU. So ARPU is basically subscription prices per month. For Netflix, they call it ARM, but they all kind of mean the same thing. So what you can see here is that the actual TAM or total addressable market is actually growing, and it's expected to grow slowly over the next few years. But we can see that the ARPU curve is actually going to be flattening and has been flattening. And this is generally the case with a lot of technology because the cost of technology decreases over time. And so users generally expect to pay less for these kind of services. The video on demand streaming market continues to grow. In the last 3 years, it's been growing at a 26% CAGR. But we do forecast this to drop by almost half to about 14% over the next 2 years. Some reasons for the slowdown, your global reopening play. More and more people are spending less time indoors, more time outdoors, traveling, and doing what they used to do. A lot of the markets are also very saturated. Penetration is high in a lot of regions. Password sharing of accounts is also really stifling growth because if you have like one Netflix account, you can share it amongst however many people, as long as there's no more than 2, 3, or 4 users at a time. And the whole industry is also competing with incumbents like cable TV and broadcast TV. So right now, video on demand streaming is only about 30% of the total broadcast entertainment market, and is expected to continue increasing with tailwinds from increased technology and as well as increasing consumer preferences. So there's still quite a long runway for streaming to kind of grow into. It's just probably not going to be as rapid as perhaps other markets. So for our last macro trend, we're going into antitrust legislation. So recently, the EU actually had this kind of agreed over this set of rules and regulations called the Digital Markets Act, and it's kind of applies to your large tech, your big cap names that have a market cap of over 75 billion euros, and at least 7.5 billion euros of revenue within the EU. So for these acts, companies that break these regulations will be liable to fines up to about to a maximum of 10% of their total worldwide yearly revenue, and 20% for repeat infringements. So the whole kind of purpose of this act is at this point in time right now is mainly to target monopolistic practices in the app or Play stores. So what they're actually kind of proposing or what they've agreed upon is to allow app developers to sideload, to use alternative forms of payment. Because right now, any apps that are on the Play Store or the App Store, any payments have to go through the Play Store or the App Store, and these companies like Google and Apple take about a 30% commission of these payments, and so this is I guess defined to be a monopolistic practice, and it's something that the EU is trying to get rid of. So one other thing is that they're going to allow users to download apps without using the App Store or Play Store. Although this raises some questions as to the security of where people get their downloads from, because Google and Apple are arguing that it won't be as secure as if they download things on their proprietary apps or proprietary Play stores. So other legislation kind of involves like no self-preferencing. Self-preferencing is basically a strategy that companies use to, especially I guess Google, they use this in their shopping category, where a lot of their listings are actually they kind of self-preference their listings for users so that they will get the most clicks and the most views on their links. There's also no need for smartphone manufacturers to install essential apps like your web browsers like Chrome or Google Maps. So that's about it for the antitrust legislation. We'll kind of move on into the stock picks. So for the first stock pick we have, we'll go into Meta Platforms. And the title here is Competition Weighing on Margins. So we'll just do a brief kind of run through of their FY21 results. Meta Meta grew revenue 37% last year, and this was really boosted by a strong rebound in digital advertising spend in FY21 compared to FY20 because of the pandemic. However, we do expect revenue growth to slow to a 2-year CAGR of about 15%. This is kind of in line with the slowdown of the overall digital ad market, which, like I mentioned earlier, is coming from moderating online activity and as well as increasing competition in the digital advertising market. In terms of PATMI, it grew 35% last year to almost 40 billion, with net margins around 33%. However, for this year, we do expect a contraction of PATMI to by 14% and net margins to decrease to about 26%. Some of the reasons for this is increased OPEX and CAPEX due to a shift in the platform's format. So they're shifting towards a more short form video kind of platform, as well as increased competition from the likes of TikTok and other social media websites. However, we still do expect a bounce back in FY23, especially as margins start to stabilize and after the company has done enough to kind of combat the increased competition and make itself more competitive in the space. With that, we'll move to Netflix. So just in case you guys didn't really know, Netflix is a subscription business model. So revenue growth is really tied to the number of paid memberships. So for FY21, revenue grew 19% compared to 24% in FY20. Reason for this slowdown is in FY20 was a really good year for them. Everyone was stuck indoors, and they had record numbers of subscription additions. But in comparison, PATMI grew 85% in FY21 compared to only 48%. And one particular reason for this is the jump in net margins. If you can see in the chart on the left, net margins grew from 11% to 17%. And this was largely due to increasing operating leverage, which is kind of shown on the chart on the right. And also, what Netflix has been doing is that they've been raising their subscription prices, which directly kind of increases their bottom line without any more expenditure. So Netflix also recently raised prices in North America as well as in UK and Ireland by $1, €1, and £1 for their standard plans. It's interesting to note that Netflix, if you can see on the chart on the right, their ARM or ARPU is actually about double that of the market average. So it just goes to show like the strong pricing power that Netflix has, which is its main advantage. Its ability to raise prices and increase memberships at the same time. And this is generally due to the kind of quality of content that Netflix has put out for its users. So we do expect a slight dip in net margins for this year. And this is mainly due to a expected $1 billion US dollar loss in foreign exchange due to the strengthening of the US dollar. So moving on to my last counter, Alphabet. Alphabet overall has been really strong. They've had really stable margins and really strong growth. In FY21, it grew 41% year on year, which is almost double their 5-year CAGR of 23%. And this was led largely by the strong rebound in digital advertising revenue, which encompasses for about 80% or slightly over 80% of overall revenue. In terms of products, YouTube still remains the fastest growing product within the advertising segment, growing 46% year on year. And this was largely led by increasing monetization on the platform. In terms of overall segments, cloud still remains the fastest growing segment, and it grew 47% last year. And this was boosted by a hybrid work environment, as well as the global digitalization trends that have been continuing. One of the key highlights is that PATMI grew 89% year on year, and with net margins increasing from 22% to about 30%. And this is because there's really strong growth in their high operating leverage businesses like the cloud. We expect growth drivers to come from a growing digital ad market and a really fast growing cloud business. At the same time, Alphabet also remains a monopoly in many of its markets like search, maps, mobile operating system, and web browsers and many other kind of product verticals. So with that, I'll pass my time back to Tim to continue with the rest of the stock picks.
Thanks, John. So we move on to Apple. We like Apple because of the 5G upgrade super cycle and also their pricing power. So the title here is balance sheet will generate returns, which is kind of counterintuitive, but the 5G upgrade super cycle is when everyone upgrades their old phones, 4G phones into 5G phones, and the 5G phones cost a lot more. So Apple will earn higher, they'll get a higher price, but not only that, they'll get the higher margins from all these products because they can just charge higher because of their pricing power. So once this super cycle is because everyone has to upgrade to the 5G. Everyone wants the faster 5G. But just that growth is slowing for Apple. So two key things from Apple is that demand from China may be hurt from lockdowns. That's number one. So China contributes about 17% to Apple's revenue. So after the lockdowns, we may see some consumer demand slowing. But the second thing is we're worried a bit about the lack of innovation from Apple. So they already had the blockbuster iPhone 13 last year. So the demand was quite good for that one. But moving on into a higher inflationary economy, and then the iPhone 14 becomes more expensive, and we may not even see. I'm not sure how much innovation Apple can put into the iPhone 14. So we're worried about the demand and the growth slowing moving forward. So right now, the title balance sheet or generate returns is how Apple is using their balance sheet to give back to shareholders. So Apple has always been doing this. So if you look at the chart, you can see that this is how much stock they buy back every year in billions of dollars. So Apple is expected to generate about more than 100 billion in cash flows this year, free cash flows. And about 82 billion of that is going into share buybacks. So that represents about 3% of the market cap. So every year, Apple keeps on buying back their share, and this supports the share price for Apple. And so this is one way Apple generates healthy profits for its shareholders, and also why it's considered sort of a safe haven to many of the investors. So we maintain a buy, but just that we worry that the stock may move sideways until a new product is launched, or is there any news that they have positive news. And there's also some sort of overhang on the stock from the regulation side, whereby there's new legislation from the EU preventing Apple from charging people, from forcing people to pay through the App Store because right now that's how they earn money from the App Store. They just force everybody to pay through the App Store, and Apple takes a 30% cut. So if the new legislation comes on, then Apple may not be able to force people to buy things through the App Store, and then they may lose a bit of that revenue stream right there. So there's an overhang from the legislation side. So we have a buy still with a target price of $214. Next slide, please. Next is Amazon. So Amazon, if just some color on what they do, they're the largest cloud provider in the world. 30% of the global market share in the cloud. If some of you did not know, and they're also the largest e-commerce player in the US, 40% market share. Just some color, Walmart, which is the second largest, is about, I think, 5% market share. So that's how big Amazon is. It's about 8 times bigger than Walmart for e-commerce in the US, because they're investing so much into their fulfillment sectors, the fulfillment infrastructure. So we like Amazon because of the secular growth from the cloud and also from digital advertising. But the worry is that they have higher costs that will linger. So they've already been experiencing higher costs, but we worry that it may linger because of these inflationary pressures. But if you look at the chart on the left, you can see that this is the capex that Amazon has spent. So in 2020 and in 2021, the capex just tripled, more than tripled that time, because what happened was everybody had to order through Amazon for the e-commerce. Everybody couldn't go out and buy things. So they had to expand their fulfillment centers, and they needed to invest a lot. And what this does in terms of expenses for Amazon is that it increases depreciation. So depreciation may be higher and is still climbing, and this may be a cost pressure for Amazon that will linger. The right-hand side, the chart shows the wage growth in the US, and it's at decade highs. Right now at 5%. And Amazon is actually a very labor-intensive company because they hire many hundreds of thousands of workers in their fulfillment centers. So this the core e-commerce business is going to get hit from this higher costs from the labor side. So because of this higher costs, this may be an overhang on the stock, but we still maintain a buy. But we think that Amazon is more of like a second half 2022 play. Once the supply chain issues abate and also when inflation starts to ease. Okay, the last slide for me. Next slide, please. Okay, last slide is Microsoft. So Microsoft, what they do, 90% market share in the global market share in the productivity software. So your Microsoft Teams and Microsoft Office. And 20% market share in the worldwide public cloud. So they are the second largest. Amazon is the first and Microsoft is the second. So both of these segments is still growing strongly. The title is both volume and pricing is up. So the two main drivers are the productivity software, which is mainly Microsoft Office. And the second thing is the cloud, which is their Azure. It's called Azure. So volume is up, all the user growth is up, and also pricing for both products is also up. So these two segments, the key drivers for Microsoft is benefiting firstly from the economic reopening. So Office 365 corporations need to use it more. More users will have to use it, especially those small and medium-sized businesses as they reopen. The cloud is it benefits from the corporates continuing to digitalize to stay competitive. And the third driver for Microsoft, which is quite a big one, is cybersecurity. Because of this Ukraine-Russia, a lot of cybersecurity attacks. Actually, Microsoft is one of the largest cybersecurity companies in the world. So this is causing a lot of people to upgrade their licenses with Microsoft, buying more expensive licenses in order to get better cybersecurity coverage. So this is what is causing the volume and the pricing to be up for Microsoft. Both up is quite a rare thing with regards to a company. So among the FANGs, we think that Microsoft is the best stock, has the best stock outlook among the FANGs. So number one, their software, so there's less impacted by inflation. So you don't have to worry about increasing costs because they are just software. Second, number two is less regulatory scrutiny because they're not as targeted by the legislators than Apple, Facebook, and Google. And also because there's secular corporate demand, they rely less on consumer spending, which is a want, but they rely more on corporate spending, which is a need. So the corporates have to spend with Microsoft because they need to stay competitive. And so we maintain a buy with a target price of $410, and Microsoft is one of our top picks. So in conclusion, growth is tapering from the pandemic spike. So there's an end to the work from home story, and also there's slower global growth, lesser stimulus from governments and all these kind of things. And other challenges include regulatory, cost innovation, and peak valuations from the pandemic spike. So our title is Selective Posture. So our selections will be Microsoft and Alphabet. But among the FANGs, we think in particular Microsoft for the reasons stated previously. Okay, with that, I'll pass the time over to Yingxie for the TA side.
Okay, thank you, team. Let me share my screen. Okay, I'll be going through the TA portion for this webinar. I will start with S&P 500 followed by the FANG companies. Okay, so I'll be using the weekly time frame, okay, to show a longer time horizon. S&P 500 itself, we can see that it has rebounded very strongly off 4,100 back in February. Okay, but currently, even though it has been running on an uptrend, right? S&P 500 is based on the weekly chart itself is currently ranging until they manage to break above 4,600. All these resistance that they will form and supply level are still heavily stacked on these levels. Okay, 4,600. This week itself is a very short trading week. Okay, we have Good Friday tomorrow. Price is trying to hang on to this 4,400 level. Okay, we are expecting to see S&P 500 to range between 4,400 towards 4,600. More upside will probably come in after the break above 4,600. Okay, I'll be moving on to the FANG companies. Okay, I'll start off with Facebook. Facebook in recent weeks, okay, recent months actually, okay, market structure itself has been turned towards the bearish side. Okay, but however, if we are looking across from 2017 onwards, Facebook itself has been running on the uptrend toward maybe end last quarter of 2021. Okay, this recent bearish momentum coming in started from the first week of April, breaking away from the previous range level. Okay, so for Facebook, we are looking at 180 to hold, okay, and 220 level to break above for more upside. Okay, but otherwise, structure-wise is currently at the bearish state. Okay, we will probably see more up move when the price starts to hold above 220. Okay, next one we will have Amazon. Okay, Amazon, same thing. I mean, it has been on a very huge range since mid 2020. Okay, recent weeks is actually bounced off 2,600 very strongly, and currently it's back in this previous range area. For Amazon itself, I mean, to really see a huge up move towards the 4,000 level, right? We currently are having a huge range, okay, from 2,900 towards 3,700, and currently price is trading in this minor range level of 2,600 towards 3,004. Okay, a strong rejection seen as well past 2 weeks, but I think the movement itself should continue moving higher. Okay, with the structure still intact, and our move should be continuing once they break away from 3,500 level. Then we should be seeing towards the 4,000 range. Okay, Apple uptrend all the way. Okay, very strong uptrend, have been moving. I mean, this uptrend has been continuing until recent months itself start to range. Okay, slowing down. Huge. The range itself is from 150 towards 180 level. Okay. Same thing. I mean, in order to see more upside towards 200 level, 180 has to break away. Okay. But otherwise, structure-wise, yes, they are still intact for the bullish side. Okay. Just have to really take note of this 150 level if price were to be trading below it. Netflix, end January, okay, earnings release. I mean, it took a very strong bearish momentum downwards towards the 400, below 400. Okay, so yes, structure-wise, yes, longer time frame, yes, is on uptrend. Okay, it's bullish structure, but in recent months, please really take note. The bullish momentum is really coming down very strongly. Okay, even though they did manage to hold above 330 level. Okay, if this level were to rebound off strongly again, okay, we probably see it ranging between 330 towards a 400 level. To really have more upside towards for Netflix, we have to see a break above 430. Okay, but otherwise, structure-wise, is bearish. All right, so have to wait for more confirmation of bullish momentum coming in. Okay, then we will have Google. Okay, Google now ranging. Okay, it's a range bound for now as well. Strong rejection of the demand level formed back in 2021. Okay, however, price hasn't really moved off much after this high, this all-time high at 3,000 level. Okay, they are still trying to attempt this 2,500 level. Okay, so as long as 2,500 don't break, structure-wise, we are still, I mean, it's still range bound. Okay, just take note, once 2005 breaks, the structure will slowly turn towards the bearish side. Okay, but for more outmove to come, 2008 will be the key level to really break away. Okay, we have a minor range area here that they formed recently, 2008 level, then 3,000. Once they break, then we will see more upmove, a continuation of the uptrend. Okay, then last but not least, we will have Microsoft. Okay, Microsoft itself, structure, yes, still bullish. Okay, near term is range bound. Okay, this range itself from 300, from 270 towards a 300 level, right? It's actually range bound for quite a while now. Okay, they attempted to break 2 weeks ago and last week failed to do so. Okay, after that they did a gap down towards this 300 level on Monday. Okay, but otherwise, this range bound, right, I think Microsoft should still stay in this area. Okay, they should be still quite safe with 275 still holding very strongly. But then again, to have more room for our move, 310, they have to close above and really show more bullish momentum in this in Microsoft itself. Okay, then yeah, with that, right, I end off this technical analysis segment. Okay, feel free to join the Poems TA Telegram channel. We have weekly webinars and live stream. Okay, so if you have any other requests for counter reviews, right, you can put in the comment section in the Telegram channel. Okay, then I will pass the time back to Tim and John for the Q&A. Thank you.
Thanks, Ying Jie. So let's just jump right into the Q&A. I'll take the first question. So can up go up if investors hold on? After all, innovative companies usually take a longer time horizon. What do you think? Yeah, it can definitely return in the longer term. But just that the up innovation ETF is a leveraged, you can look at it like a leveraged Nasdaq. So it really went down a lot in the previous 15 months compared to the FANGs. So it's down maybe like 60%, I think, in the last 15 months. So it's much riskier to hold it. So you definitely have to have a bigger stomach to hold it. Next question, among the FANG stocks, if you were to buy one, which one will it be and why? If I were to buy one, I think Microsoft, it has the best outlook. So it has lesser uncertainty from the legislative side of things. So there's lesser regulatory scrutiny on them compared to Apple, Google, and Facebook. And also the growth is more from corporate demand, which is more of a need rather than a want. And also they're less impacted by the high inflation at the moment because they're software. So the outlook looks the best for Microsoft in my opinion. Next question is, are we going into inflation or recession? So I think we're already in inflation at the moment. For recession, we think it's unlikely because the economy is still strong. It's just that we're slowing down. So inflation is high, but growth is slowing down. So we may enter into a time of stagflation. But I think it's unlikely we're going into a recession in the near term to medium term. Maybe at the end of next year, according to the yield curve. Are the FANG stocks still overvalued now, given prices have come down recently? We think, with regards to valuations, we think that valuations may not expand anymore because of the slower growth. So right now, valuations are still above historical average. So at best, I don't think it will go higher. It will probably remain flat. So what we think is that the earnings is key to share price performance in order to break the new highs. So what's important now is earnings visibility, which we think that Microsoft and Google has better visibility. So that's two of the stocks that we are selective on for the FANGs at the moment. Okay, maybe John, you want to take the C Limited question?
Yeah, sure. So we have a question here. What do you think of C Limited, Singapore company listed on the Nasdaq? So we actually put out an initiation report on C, I believe, a couple of weeks ago. And for C, it's all about the TAM, the addressable market. You know, there's still a company that isn't profitable. They're still burning cash quite rapidly. And they do have several headwinds in their digital entertainment business, which is basically gaming. But they do have some bright sparks, and that will be generally coming from growth in e-commerce and digital financial services. So their e-wallet payments, they are also moving into microfinancing. and other sorts of financing. So if you want to look at Sea Limited, you really have to look at the macro environment of where they are operating in, and whether or not there's still a lot of growth in those kind of environments. And for right now, there is still quite a lot of growth, a lot of runway for Sea to move into even newer geographies, newer markets. So we do think that it could be a really good company, but for right now, if you just look at a cash flow from a cash flow perspective, and the fact that they've raised a lot of money via convertible notes, it is a bit. I guess you have to really love their services, and the good thing is that their services are great. I mean, Shopee is a really good platform. It's the #1 e-commerce website in Southeast Asia and Taiwan, and they've just expanded into Brazil as well not too long ago. And yeah, so overall a pretty good company. I mean, amongst the if you compare just Sea and Grab, I mean they are similar companies, even though they operate in different verticals. But I would definitely look at Sea as having the upper hand over there. Let me take another one. The next one is just curious, why no recommendations for lower price tech stocks instead of focusing on FANG, where the target price, for example, Alphabet is 3,000. Hope there are recommendations of more affordable price range stocks. Yeah, so actually, like I mentioned earlier, Sea is right now is at $100+. So we do have a target price for that. We also have a target price up for Adobe, I believe. But just for this presentation, we're mainly focusing on big tech. But good news, Alphabet and Amazon announced a stock split, 20-to-1 stock split that should happen in the third quarter of this year, so sometime in June. So that will definitely make it a lot more affordable for the masses, because you're looking at $150 per share now when that happens. I should take a. How about commodity or commodity-related stocks? Unfortunately, we don't really cover commodity and their related stocks. How much more can they climb up? This is a great question. I mean, I guess if you're looking at gold and silver, these kind of inflationary hedges, you could see gold or silver prices go up, which by definition would raise the prices of your gold miners or silver miners. But in terms of other commodities like oil or copper, they've been declining quite significantly over the last few weeks. Okay, so why is this seminar so focused on US tech? Can you discuss some US non-tech stocks? For example, Occidental Petroleum, Archer, Daniel, Midlands, Berkshire Hathaway. Yeah, so one of the reasons why we're focused on tech stocks is because we only, as of right now, we only cover the US tech stocks. I'm not sure how to touch on this, how to actually answer this. We basically don't have enough people to cover the whole US market because it's so big. And so our strategy right now is to focus on the companies that are most heavily traded, which is incidentally are your big tech stocks or just tech stocks in general. Yeah, I'm sorry we can't really, we don't have coverage on other sectors as of right now. I guess that will be all for me. Oh, sorry, I see one more here. May I know which one to buy, Alphabet, A or C? It really doesn't matter. The only real difference is that you have voting rights for Class A. For Class C, you don't really have voting rights, and the share prices are about the same. So yeah, if voting rights, if you're worried about voting rights, then get A. If not, you can get C or both. It doesn't really matter. Yeah, because trading volume and volatility is pretty much the same. Yeah. So I think with that, I'll pass my time back to Tim to answer some more.
Yep. The next question, CF Industries performance. Sorry, we don't cover CF Industries. Next question.
I believe they do hydrogen. or nitrogen
Oh, is it?
manufacturing. Yeah.
Sounds quite. Yeah, we don't know about the industry much. The next question is, what is CAGR? CAGR stands for compounded annual growth rate. Sorry, we didn't mention that. So compounded annual growth rate means, in a simplistic way, how much they grow every year. So if they have a CAGR of 21%, that means they are sort of growing 21%. Yeah, roughly around there. It's a compounded annual growth rate. It's, yeah. What do you think of Elon Musk's offer for Twitter? Is it likely to go through? Thanks. So for acquisitions, it's a bit hard to predict whether you go through, or even when it happens, when someone announces it, like Elon Musk. And Elon Musk did try to take Tesla private in the past, right? But it didn't go through. So it's very, very hard to predict, especially when it comes to Elon Musk. So sorry, we got no view on it. Next question, if I have to invest 50K in the FANGs, what would be the reasonable entry price and distribution of 50K? This one, I think you can look for perhaps your investment, because we're not sure about your investment objectives. Yeah. Or in fact, maybe a TA person also. You can join Ying Jie on his Monday webinars, or you can join him in the Telegram group chat, which is, you can see the QR code at the middle, and you can just drop him a question about a good entry prices for the FANG stocks. Next question, how do you come up with the target price? Microsoft target price is $410, far away from the current price. Our target price is based on a DCF valuation. So for Microsoft, is the terminal growth rate for the DCF valuation is 4%, which is slightly higher than the average US GDP growth of 3%, because we expect Microsoft to grow faster than the US economy, because it's like a tech stock. So we expect the tech stock to at least grow slightly faster than the US economy. So that's how we derive the target price of $410. Also based on our earnings estimates. What about cloud providers stocks and ETFs? The three biggest cloud providers we already covered here is Google, Microsoft, and Amazon. ETFs are not too sure. Maybe you can consult your trading representative for advice on that. Okay, the PE for Microsoft now is 30.6, higher than average. Is this a good time to buy in? So timing, I think with regards to buying now, I think it'll be an earnings play, because Microsoft earnings is coming out on the 26th of April. And Microsoft results previously in the previous quarter was, our title of our report was firing on all cylinders, because they beat earnings estimates and margins all across the board. So, and we think that this growth can sustain for reasons we explained just now, because corporates, when they invest in the cloud, they're doing it for a need, and also they have a long-term view on this. They invest many years into this. So it's more, you can look at it at a more stable kind of visible earnings, higher earnings visibility. And also there is lesser, I guess, risk from regulations and also from cost side of things, from the inflation side of things. So we think the growth for Microsoft can be sustained. So we think that if you buy now is play on the results. So you can get good returns, I guess, positive returns if the results is good, coming on the 26th of April. Any views on cryptos or crypto related stocks, please? Sorry, we don't cover any crypto stocks.
Tim, you want me to take some?
Yeah, sure.
Okay. So I'll take this one. Since Alphabet is going to split shares in July, is it better to enter now or wait until they've split shares? So the interesting thing about stock splits is that generally for 2 or 3 months after the company's announced a stock split, shares, the stock price performance is usually pretty good. That being said, we can't give you a definite answer on whether whether to enter now or wait until they've split, because it also depends on what your investment objectives are, and your kind of holding power and your time frame on what's the purpose of going in the first place. But if you want to know more, you can also look for Ying-Jie, because he does the technical analysis webinars every Monday evening at 8 p.m. I believe. Over here, what's your view on Tesla? Unfortunately, we don't cover Tesla, but if you just want my opinion on it, it also depends on how long your kind of outlook for the company in the next 5 to 10 years. If you're thinking about it from a trader's perspective, it's a super volatile stock. But for let's say a 5 to 10 year view, it's definitely going to be a very it's a good company to have, especially with the prices of oil increasing and a lot of governments around the world imposing their kind of strategies to go carbon free in the next 10 years. It'll basically make all your ICE your internal combustion engines obsolete, and that's really when you'll see the value of having an EV company. But that being said, they've done a lot. They've opened a lot of factories worldwide. They are suffering a little bit from the factory shutdown in Shanghai, but we think that's probably just a very short-term overhang. Yeah. So the next question is, what do you think of NVIDIA? Since more and more EVs, blockchains are using its chip. Yeah, NVIDIA is also a really good company. I think we don't cover it, but it's definitely it does seem a little bit overvalued right now. It's trading about 55, 60 PE. Compared to your average Nasdaq PE, which is like 20 or something. But yes, so likewise, they've got a very good future ahead of them. Almost everyone is using their chips. I guess for NVIDIA and other semicons, it's just a matter of whether they're able to handle their supply chain efficiently, and also the capacity and how much they can produce going forward. Let me see. Oops. NVIDIA. Among the big tech stocks, which one has the worst fundamentals and technical perspective? Any short opportunities?
I don't think we have any short opportunities.
Yeah.
I don't think we have. All our recommendations is either accumulate or buy. We don't have any sell. So sorry, we can't say there's any short. Maybe the TA side can share, but not at this moment. We can join the Telegram group chat.
In terms of worst fundamentals, it probably would be Meta at this point in time, mainly because they're seeing slower user growth, increasing competition, and they're really only reliant on digital advertising revenue. So they don't really have a diversified kind of portfolio of revenue streams coming in. So if something happens to their main digital ads, which they are competing with Google, who is the market leader. So in terms of the worst fundamentals, even though their fundamentals are still pretty good, their cash flow positive by a long shot. They do a lot of share buybacks and stuff like that. Yeah, I guess I'll hand it back to you, Tim, to answer some more questions.
Sure, we'll take two more and then we'll end it because it's already 9 p.m. But any questions, please do drop us an email or you can go to our website and drop us and put a comment there, and we will happily reply you there. So two more questions. The first one, are we going to enter into a stagflation scenario? Under a stagnation scenario, which sectors would benefit? Stagflation would be, I think, defensive stocks, because it's a slower growth, so everybody's worried about growth, so they'll try to stick to defensive stock, maybe consumer staples, REITs, utilities, and these are the sectors that actually outperform the tech stocks in the first quarter of this year. So the Nasdaq was down 10%, but all the defensive stocks were actually flat, like down 1% or this kind. So the defensive stocks did better during this time. And the last question we have is, do you feel Amazon is still a good stock pick given their revenue is coming from AWS, which is also targeted at corporate customers? Yeah, we still do like Amazon. AWS is a big growth driver for Amazon, 50% of profits, 30% year-on-year growth. Just that the overhang for Amazon is the expenses. So that's the thing that may negatively, that may put some pressure on the stock price. But overall, Amazon is still growing quite healthily. Yeah, it's just the margins that there is the worry at the moment. Okay, and with that, I'll pass the time over to Vivian.
Thanks, Tim. So thank you, Tim, John, and Ning-Jie for the interesting sharing. We have now come to the end of the webinar, and we'd like to thank all of you for joining. And please do take the time to fill in the survey so we can improve your experience with us in the future. You may scan the QR code or copy the survey link posted on the chat tab. You may also join our investing communities to get free access to full research reports and discussion on technical analysis. If you have missed out on some parts of the webinar, a recording of this webinar will be available on PhillipCapital's Facebook page and on YouTube soon. So we do have many other interesting webinars going on almost every other day, and you may view our full list of free webinars on our website. Hope to see you for next quarter's strategy and stock picks in July. Thank you all for joining us, and we hope to see you at future events. Take care and have a good weekend, everyone.